Hello, this is Eric Parnell, Chief Market Strategist of Great Valley Advisor Group. August has taught us an important lesson about the long-term discipline of investing. It was only a few weeks ago when the month of August started and all of a sudden the S&P 500 was careening to the downside. We saw the headline index fall by nearly 10% over the course of 3 days. And it caused a lot of investors to question, should we do something? And the resounding answer in August, just as it has been throughout market history, is no. Markets are prone to volatility. We'll see upside jags and downside jags in the market at any given point in time, but they don't affect the long-term plan. The key is to stick to our discipline. So why shouldn't we react if the market's all of a sudden moving to the downside? Well, the challenge associated with that move is that you have to be correct in getting out on the downside, and you also have to get the timing right getting back into the market. If an investor had reacted at the beginning of August to this short-term volatility, they would have missed out on the bounce that has taken place since. And it's been a strong bounce, taking the S&P 500 back towards its 5,600 all-time highs. Looking back through market history, we see this happen time and time again. We can go through extended periods of correction, but the important thing to remember is that a long-term investment plan, if constructed properly, should be prepared for these types of outcomes. We go back to the year 2000 when the S&P 500 peaked at 1,500. It fell by nearly 50% over the next 2 years, but it subsequently bounced back to reach new highs. We saw it again in 2020 with the outbreak of COVID, with the S&P 500 at new highs at 3,300. It dropped by nearly 35% in over a month, but then subsequently bounced back to reach new all-time highs. We've seen it happen time and time again. Trying to react when the market's in the midst of a storm is a good recipe for derailing your long-term investment plan. Because each time we've seen these downside incidents in the past, the market has shown the resilience to bounce back. But an investor could naturally ask the question, what if it doesn't bounce back this time? Well, that's part of a proper asset allocation. Because it's not just about the stock market. It's why we invest in bonds and other asset classes outside of stocks. And even within our stock allocation, that's why we're not just focusing on the S&P 500, but all of the stocks that make up the S&P. Because even if the headline index is going down, there's almost always certain parts of the market that are doing well, even when the broader market is following. So we've seen some market volatility recently, and it's not going to be the last time. We'll see these types of downside periods again, and they may last weeks, months, or even years. But the most important thing to a successful investment plan is sticking to your long-term discipline and riding out these storms. Thanks for joining me for this latest market insight, and I look forward to seeing you again soon.